Welcome to Real Talk Divorce San Diego. My name is Lynn Waldman. I'm a therapist and divorce coach, and you can find my website at divorcecounselingcenter.com. And I would like to introduce my co-host, Shawn Skillin, family law attorney, and Shawn's website is shawnskillinlaw.com. Mark Hill, certified divorce financial analyst, and Mark is with Pacific Divorce Management. His website is pacdivorce.com. And we would like to remind our viewers that we have a divorce options workshop the first Saturday of every month. So this Saturday, February 2nd, is our next workshop located in Carmel Valley. If you would like more information on that workshop, please go to collaborativefamilylawsandiego.com or call 858-472-4022. And during our show, please feel free to write in with any questions, and we will do our best to answer your questions live. And our topic today is your divorce and the new tax law. And we're so happy that we have Dave Gibbs with us today. Dave is a CPA, and you can reach Dave at dave@gibbs-cpa.com. Dave is a native San Diegan, a rare find in San Diego these days. And Dave was with a large regional firm most of his career before moving to a smaller firm and now to your own practice. And I understand your focus is individuals, closely held businesses, flow through entities with a fair amount of real estate. And Dave, tell us what prompted you to start your own practice. We'd like to find out more about you today.
Thanks, Lynn. Really, it was just being able to kind of do what I wanted to do and work with the clients that I wanted to work with, and not worry about, when I was at the larger firm, whether it was a client that fit our profile, and even at the smaller firm, you know, dealing with other clients and things like that maybe I didn't want to work on. So it just seemed like a good time to take the years of experience I had and start my own practice and kind of work on the clients that I wanted to work on.
Well, we are glad to have you here, and we've got some questions lined up about the new tax law and how it might impact divorce. Ms. Skillin?
Well, I think we've talked a lot about the spousal support deduction, but where I'd really like to, and we'll talk about that today, but I'd also like you to talk about kids. And, you know, we used to talk about kids as exemptions or deductions and how that would work, and we'd work out which parent should claim which kid and all of that kind of stuff. And that's changed quite a bit. So if you could talk about that and the age limits and things like that, that would be great.
Absolutely. With the tax law, the big thing that was taken away as it goes with dependents and even the taxpayers themselves is the deduction for the personal exemption and the dependent exemption. So if you had a dependent, you got an actual deduction for that dependent, and that's now gone. But the type of the kid that can be claimed as a dependent, none of those rules really change. So you're still going to have to think about, you know, who the custodial parent is, the non-custodial parent, what the agreement says, who's going to claim them for those sorts of things, and for the head of household filing status. None of the rules as far as who's the dependent, who gets to claim the head of household filing status changed either. So where the big change is getting rid of that deduction, but how they kind of made that not as painful is they increased the child tax credit. So the child tax credit used to be $1,000, now it's $2,000, and up to $1,400 of that is refundable, which means even if you don't have enough tax liability, you can actually get money back as a bigger refund.
But only up to $1,400.
Only up to $1,400 is the part that can be refundable. So, and it's like everything else, there's a lot of complexity in the calculations and things like that. So you can get up to $1,400 back, but it goes through a whole bunch of calculations for how much that will be. But the other nice thing they did with the child tax credit is the income limitations used to be relatively low. For a married filing joint return, it was $110,000. And, you know, obviously in Southern California, that if you're making $110,000, you're not necessarily well off enough to not need or want to get that $1,000 child tax credit. So they've significantly raised those thresholds to $400,000 for a joint return, or $200,000 for a other return, which would be single, head of household, or things like that. So They doubled the credit, and they made it so a lot more people will be able to claim that credit.
So is it $2,000 per child?
$2,000 per child.
Okay, great. And so does the person, so a lot of times people have joint physical custody. They have kind of a 50-50 child sharing arrangement, and for purposes of taxes, we'll say one parent has 50.1%. So they can claim that child and file as head of household instead of single, so both of them can do that. Does the child tax credit have to follow the child to the parent who's claiming them for purposes of head of household? Or can they trade that off? Because in the old days, they could each claim a kid to be able to file head of household, but who took the child as the exemption could be traded off by filing the, I think it's the 8832.
Right.
So can you still do that for purposes of the tax credit, or are the two married to each other? Bad choice of words, I know. For purposes of taxes.
Right. The two aren't necessarily married. For head of household, you do have to be the custodial parent. So you do have to be the 50.1% where the child is actually residing. Now, if you're not the custodial parent, you can be given the dependent with that Form 8832 for purposes of the child tax credit. It doesn't give you the ability necessarily to file head of household because you're still not the custodial parent. But that can be part of the negotiation or whatever, where the non-custodial parent, the less than 50% parents, can be allowed to use the dependent for the credit purpose.
So that's nice, because when we're going through a divorce situation, then people like Mark and I are always trying to figure out how the two clients can maximize the tax benefits. And we're always running things through the computer to see who should take who and who should claim who, and how do they, as between the two of them, give the least amount of money to Uncle Sam and keep it for themselves. So then my other understanding of the child tax credit is that it phases out at a certain age of the child.
Yes.
And so what's that age?
That's 17, and so that's determined on the last day of the year. So if you've got a child that turns 17 on December 31st, unfortunately, you do not get to take the child tax credit that year for that child. It's not prorated based on the number of days that they were under 17 during the year. It's just however the age was on the last day of the year determines whether you get the credit or not. So it's...
Now, just for clarity, Dave, what we're talking about is federal, not California state, right? This is just federal rules at this point we're discussing, because California has not followed, in my understanding, what the feds have done as they've done in the past.
That's correct. California, all the tax law that you've seen on the news or in the newspaper has been talked about, none of that has anything to do with California. California doesn't conform to anything. So some of the other things we'll talk about later, the alimony and things like that, California didn't change. So you're going to still have to think about California taxes when you are coming up with support calculations and things like that you may have thought, oh, we're after 2018 now, it's not going to matter. Well, for California it is going to matter, because it is still going to be income to the recipient and a deduction to the payer.
So do you have any inside scoop? Because I know last year the inside scoop was that everybody thought that California would conform to the federal laws, and by the time the guidance came out for the 2018 tax year, that California would have conformed and everything would be on the same page, and they haven't done that. So do we think they're going to do that, or do we anticipate having two totally different tax systems for a while?
The conferences I've been to at the end of the year, nobody seemed to think that California was going to be rushing to conform to anything. Now, whether they kind of piecemeal some of it, maybe they will conform to the alimony. I'm not sure, but as of now, there's not any talk really of there being a lot of conformity by California.
What's the potential fallout for that? Or
it's just remembering that it's going to be different, especially again, if we're in we're in the regime now that alimony is not taxable, not deductible. It's important that the people now understand, though, for California, if you're in California, it is still going to be taxable and deductible. You don't necessarily want the recipient to get blindsided all of a sudden because they didn't think they were going to have income for this at all, but for California they do.
So really, I think it just increases the complexity. I mean, that's really
It
what we're
does,
dealing with, and you need to look at these two independently, the federal and the state taxes, and see what the overall impact is. And we're just hoping that the computer programs are getting up to speed and doing so. We were discussing that before we came on air. So,
Yeah, so I know that DiscoMaster takes into consideration tax differences like California rates for disability insurance and things like that. We can turn those on and off in the program. But some of these other things we're kind of assuming that they've taken into consideration in the programming, but we will be following up to find out for sure, because I think everybody thought that California was going to conform. So record keeping, there's a lot of things like for small business owners that, you know, deducting your entertainment and your meals and things were no longer going to be allowed. So I know that people are looking at in different terms now, but California, those things are still deductible. So
Absolutely.
in terms of record keeping, keep everything.
Yeah, as far as record keeping and things like that, you really, because of the California nonconformity and with everything being the same for California, you got to just keep all the same records you had before and kind of continue to keep your books the same way that you did before, because you don't want to miss anything because you thought, oh, well, it doesn't matter, I can't deduct that anymore. Well, you can for California still, so.
and 10 cents on the dollar is 10 cents on the dollar.
Every deduction helps, so.
Yeah. So going back to the world of spousal support, and as everybody who's been following our show knows for the last year, that as of January 1st this year, for new divorces, orders that are entered after January 1st, spousal support is no longer a deduction for the person who's paying it, and it's no longer taxable to the person who's receiving it. Under federal law, under California, it's still the same. But there was some confusing publications that came out the end of last year, one of which said that any spousal support modifications, any changes in support after January 1st, 2019, would fall under the new rules instead of the old rules. My reading of the statute itself that was passed in December 2017 is that anything that was entered into prior to January 1st, 2019 will remain deductible and taxable. Although there was one publication came out from the IRS and said just that, and the other one came out and said, oh, no, any modification going forward will no longer be deductible or taxable. What's your call on that one?
Modifications to an old order, if you will, under the old rules, will continue to be taxable, deductible, provided that the modification doesn't change it so that it's not alimony under the kind of traditional sense that gives rise to the tax deduction. And as long as the modification doesn't expressly say that they want the new tax law to come into play and to make it not deductible.
So it's grandfathered in, unless they, in writing, decide to opt out.
Correct. And it's got to be expressly stated that you are opting out of the new law. You want to continue to be under the old law. And again, that the modification doesn't change it so that it's not really considered alimony anymore for tax purposes.
All right. So, and again, for purposes of California, nothing changed.
California, nothing changed. So any modification doesn't matter, again, as long as it's still considered alimony, because California still follows the same basic rules of what becomes deductible alimony.
So here's a question I get from clients all the time, and I'll tell you the answer I tell them. I don't know if it's the right answer. Full disclosure. So the question of they owe $500 a month as alimony or spousal support and $1,000 a month in child support. And they just want to write one check or make one automatic transfer to their ex-spouse for $1,500. And I always say they should do two separate ones for purposes of record keeping so it's clear, because there's a different tax treatment for both of those. As the accountant, if somebody just wrote those $1,500 checks all year, how do you figure that out for purposes of the IRS? Do you go back and rely on what was said in the MSA, or do you just how do you do that?
Yeah, we look at what the MSA says and what's the split supposed to be and go with that. I agree, though. I would prefer to see a separate check for the alimony and a separate check for the child support, just so it's easier. If you happen to get into an examination, you can just give the IRS agent, here are the alimony checks, and here's the MSA, and it all ties out. But it shouldn't matter as long as you are matching what the MSA says, and as long as the recipient is also reporting the correct amount as well. I mean, most of my experience with it is where there's a disconnect between what the payer says was alimony and obviously what the recipient says was alimony, and that's where that triggers IRS notices and things like that because it doesn't match. And
Which I think people should know that, you know, all of this is computerized nowadays in the IRS, and they are very good now at matching up, like say you're divorced and you've got 3 kids and you've decided that Mark over here will claim 2 of them and I will claim 1 of them, and we screw up which kids we claim and we both claim the same one. Their computer matches those Social Security numbers up now, and you get nasty little letters,
Or
you
if
know,
I say
maybe
that-
not right away, but within a year and a half, saying, hey, you guys screwed it up, and now you owe us, one of you owes us money, plus interest and penalties. So it really is a good idea to be careful and check your MSA and make sure you're doing the right thing, because it's not like they'd have to go through and read these returns one at a time. It's all computerized.
And that is,
spouses who have literally, any check I write to her, I'm going to add it on. So whether it's child support or whatever, I'm
Right.
going to put it in, let them work it out.
Yeah.
And guess what? They do.
Mhm.
As you say, it takes sometimes 2 or 3 years for them to come back on it, but they will.
And the
Because-
nice thing about electronically filing now, if you had that situation where Mark has already filed his return and claimed that child with that social, when you try to electronically file it, it's going to bounce back to me. He's going, nope, that dependent's already been, and then we can.
But the other
Then we
thing
gotta
I've
sort it
recommended
out.
for years is that have the 2 accountants talk to each other
Absolutely.
during the process of filing the taxes, especially in the early years.
Yes.
It can save a huge amount of problems, and if there are discrepancies, you can get to address them before it's filed with the IRS, and you have to do it post-filing.
Well, and sometimes I think in that situation, if you're both working with the same accountant or accountants that will talk to each other, then again, you can take advantage of kind of maximizing some of these things that you can trade off and keep your tax burden down. So always a good idea if you can cooperate in that way on taxes. There was something else I was going to ask you. I'm trying to remember what it was now about the kids, but I'll come up with it.
Okay.
Oh, spousal support. No. So sometimes people do adjust child support or spousal support just kind of on their own with no court interference or attorneys or anything, no written orders to the court. And so say husband magnanimously says, hey, I got a raise, I can throw in a couple $100 extra a month for spousal support, and he's even writing a check that says spousal support. Let's say he's writing a separate check and the 500 went up to 7. Is he going to be able to deduct that without a court order behind it or not?
Maybe.
Maybe.
It's really, like you talk
Well,
about.
IRS is not all black and white, people.
Well, because like you said, the IRS isn't going to review the MSA, isn't going to look to see if there was a court order or anything like that. If the recipient is agreeable to take more income in based on the additional alimony they've decided on, then nobody's going to say anything. It's still going to match up.
Okay, so what if husband's writing the $700 check and then wife talks to her accountant and says, you know, there's no order, so can I just claim the $500 as income and not pay the taxes? Then how does the IRS sort that out?
Then the IRS is going to go to the MSA and say, what's the MSA say?
Okay,
And
so what
yeah.
if there's, the MSA still says $500, but there's clearly a string of emails between the two that says, hey, I can pay you another $200 as spousal support, and she says, okay, that's great, and he says, hey, remember that, you know, we got to straighten that out on our taxes. Is that enough, or do they look at the court order?
They're going to look at the court. I mean, if you get to a point where you're that involved, they're going to go to the court order, and that's going to be the determining factor.
So it would really be more wise for a couple like that to go and have a modification and have the court order. That way there's no questions.
Right.
That's going to make it,
Crystal
bulletproof.
clear.
Yeah.
Yeah. So that's what I always tell my clients is if you change how you want to share Christmas or who takes what week during the summer, and it's just between you, custody and visitation, nobody's going to care. But if you're going to change something financial, then you should do a new court order and submit it to the court, because not only, as we've just heard, will the IRS kind of look at that if there's an argument, but if you need to have go back to court, the court is going to look at the last financial records that they have on file.
And I would say this, that, and I've had this experience where a couple literally did that and called me and I said, you should get a court order, you should get it done. And they didn't, and then everything was fine, they were friendly about it until there was a significant other that came into one of their lives, and suddenly it wasn't fine anymore. They were arguing about everything. And I don't know how that resolved, but it certainly raised red flags for me.
Mm-hmm. Yeah, somebody I've worked with for most of my career is his saying is everything's fine till it's not.
Not fine, yeah.
Yeah.
Yep.
Yeah.
Very true.
And it just seems to make the most sense if you're going to modify something, get it in writing, get a court order. That way it doesn't depend on if there's a significant other or if the spouses have decided to change something, because I've seen that too, and it's even for people who've been divorced for a long time, then all of a sudden it's difficult for the whole family, the adult children, and can really create some chaos.
Yeah, and we don't want to scare you off on entering into new relationships, because many times new relationships go just fine, and sometimes your new spouse gets along with your old spouse just fine. But we all have seen cases where the two exes have been getting along great, the court file's nice and thin, and then a new love interest comes in for one of the parties and everything kind of blows up because what you've been doing between yourselves isn't what they were used to, isn't what their divorce is like or their parents' divorce is like. So keeping everything in writing and making it clear makes the rules clear for everybody, and it also kind of gives you an excuse to say, hey, you know, we worked this out already, we've been to court, we've got this done, I'm not going to go get new lawyers and do something different, this is the deal. And if they still won't go along with that, then you guys all know what I say, run far, run fast, run the other direction, no matter how good the sex is, and don't get involved with that person.
So it looks like we have a question. Claire,
Yeah.
could
So
you?
Lucci says, what if I write a check to my spouse as a gift instead of paying alimony? How would that impact my taxes?
Great question.
Gifts are never deductible to the payer, never income to the recipient. So if you are being generous and you're just going to give a gift, then there is no tax impact.
And slight modification on that, what if it's like a loan that's the spouse who's paying the support gives a loan to the receiving spouse, I mean, and never asks for the loan back, or like, what happens with that?
Then it's probably
Is that
still going to
the
fall into
same?
yeah, it's probably going to. Now, you know, if there was actual loan documents written up and things like that, and the lender's ex-spouse wanted to push it and try to collect, and then could actually take it as a loss, and you know the recipient spouse then would have income for cancellation of debt. But you know, if this is just an informal, hey, I know you need a little extra help, here's a loan, pay me back, great. If not, no big deal. It's going to fall under gift.
Okay.
So we come across cases all the time where there is a real difference of financial knowledge within the marriage. And that works great during the marriage, but when couples separate, there can be an imbalance of knowledge, and that represents power in the divorce. What should the non-moneyed spouse be looking out for, taking with them, getting copies of, if they feel that the divorce is imminent and they've never really been involved in the finances? You know, here, honey, sign the taxes. You know, how many times has that happened during a marriage? But now suddenly they're going to have to be the responsible party. What kind of documents and what kind of information would be critical?
I think the first is, if it's imminent or if it's already the process has already started, is to get in contact with your tax advisor and get a copy of the return, because you, like you said, that spouse may not even have a copy of the return.
Sorry to interrupt, but I've had this happen all the time, where the wife will go, I never talked to him, he won't give it to me. I've called him, he doesn't call me back.
The tax advisor?
Yeah. And that's
Yeah.
I mean that's a problem, because that's, you know, that kind of goes against the professional.
Isn't there a fiduciary
Yes,
responsibility on a
absolutely.
joint return
On a
that
joint
you represent
return,
both parties,
correct.
and that so they shouldn't be fobbed off, basically, right?
No. Now, you know, it definitely could be something where you don't necessarily want to get involved in what's going on, but you do have a duty to provide a copy to the spouse, and I'm actually going through that with a client right now, where the spouse looks like they're going to be getting divorced, and I had never spoken to the wife that much, but here she reached out and let me know what's going on. I was like, okay, I'm so sorry. Here, yeah, absolutely. Here's the copies you need, and you know, let me know how I can help or what you need me to provide. But yeah, at the minimum, try to get that tax return, you know, as soon as possible. And you will want to reach out, and hopefully your tax advisor is understanding and will help answer questions and things like that. But if not, you should find one for yourself that can review your tax returns for the last few years and kind of give you a guide as to what to look for and what the issues may be, you know, post divorce.
Is there any ethical or professional standard that prevents you from working with both parties after the divorce if you worked with both of them during the marriage?
You do have to be somewhat careful as far as conflicts of interest and things like that. It's best to get something in writing from both sides saying, okay, I'm going to be your advisor or represent you both. I want you guys to understand that so everybody's on board. Because you can run into things where, like the example you gave there, where the advisor doesn't want to talk to the wife. Well, that's looks like a conflict of interest right away. If you're not even going to talk to me, how are you going to have my best interests at heart? And I probably need to find my own. So you can do it. You just definitely disclose, and what's best is to get something in writing to let everybody know that they understand that you're working on both sides.
All right, so one of the other things that was changed on the federal level for the 2018 tax year was the amount that you can deduct for mortgage interest and property taxes. In a lot of places in this country where property is a lot less expensive, it turned out to not be a very big deal. But here in California, especially Southern California, LA, the Bay Area, property is very expensive. So there's new limits on that. And often when people are getting divorced, they are each looking to buy a new place, so they have to consider the advantage or disadvantage of mortgage interest and property taxes and what those limits look like. And then in the case of people who are older, the ability to take their tax basis with them, and only one person can claim that. So, so I just threw a bunch of stuff at you. But start somewhere and give us answers.
So the new tax bill did change, and this is going to be for new mortgages after December something of 17, that lowered the amount of interest that you can deduct on $750,000 of debt versus the old $1 million. So, but this is again something that's got a grandfather clause. So if you've got your existing debt that's $900,000, you can still deduct all of your interest, assuming it's qualifies as acquisition indebtedness and everything like that. The other change is the cap now for federal purposes again on the deduction for property taxes and state income taxes. They lump all that together. You get to take $10,000. So if you've got $12,000 of property taxes and $20,000 of state income taxes, the most you could take for federal purposes is the $10,000. So that's where the big change to property taxes and mortgage interests really came into play.
Roughly how much money do you have to be making a year to pay California's state tax of $10,000 or more? Because state tax laws are so much different than federal.
But California's a high tax state, so 120 to 125 is going to get you close to that $10,000 of state income taxes.
Okay. So then, I don't know, what would you tell people that are looking to buy? Is it still an advantage to them if they're not going to get that, let's say, $8,000 a year in state and a deduction for the property taxes they're paying, which is not that much in California or Southern California, LA, or Bay Area, and they're already at the threshold of that $10,000 on state taxes. I mean, that was always a big deal. You got to take that deduction.
Right.
So is that something you can kind of do that math for them? Because I think that people, when they're trying to figure out their budget, are thinking about all these things.
No, and I think if you do need to look at that more and kind of project what the tax benefit is going to be for that purchase, because you're right, it used to be like, oh, I'm going to get so much more in deductions now because of all the property taxes and the mortgage, and so it's just a no-brainer, of course, to do it. But now, yeah, you're going to be limited on things, so you really do need to do some calculations and see what your after-tax is going to be, how much you can afford.
Well, and that even came into play when we were talking about calculating child and spousal support, because mortgage interest and property tax deductions and your state tax deductions were calculated as part of the DISO master. And when we were trying to figure out what support was going to look like and whether or not they should keep one of the parents in the home, that often made a huge difference, because they couldn't go out and rent for what they were staying in the home, and then they lost the mortgage interest, the property tax deductions, and all of that stuff. And now it's not as much of an advantage anymore, because they've lost sometimes tens of thousands of dollars in deductions.
Right. But they've also gained the higher standard of deduction, and again, California doesn't conform to any of this. So all the mortgage and the mortgage debt is still $1 million for California, and all their property taxes are still deductible. California never gave a deduction for state income taxes, so that didn't really change. But
they're going to give us federal now, right?
No.
No. Facetious comment. I knew the answer.
Okay, so what is the new amount of the deduction for a single person filing separately?
So for a single,
I guess it's the same whether you're
Yeah.
married or single.
The new standard deduction for single is $12,000, for head of household is $18,000, and for married filing joint is $24,000. And then if you are over 65, you get little bumps. So if you've got married filing joint and both spouses are over 65, you get, I think it's 26,300 or 26,600, somewhere around in there. So there's going to be a lot of older taxpayers, married filing joint, that for federal purposes probably aren't going to be taking the itemized deduction anymore, because more than likely their mortgage interest is relatively low, their property taxes could be relatively low. Charity, they're charitable, but they might not be that charitable to get over that hump of the 26,000. But again, for California, none of those standard deductions change. So for a married filing joint, it's like $8,500. So between their property taxes and their mortgage interest and their charity, they'll still probably itemize for California. So you still got to, again, like we talked about before, you still got to keep track of everything, keep all of your records, because you don't want to lose out on a deduction just because you didn't think you were going to get it anymore.
So should I expect to be paying my CPA more next year for this extra work, or is this just what you guys do?
Is this a personal question?
It's always
Ask for a
interesting.
friend.
I'm asking for a friend.
Yeah, really.
It certainly has added to the complexity, and it makes it more difficult or more involved for us to give good advice or to give an accurate projection of things than it used to. So yeah, there may be some additional fees and things like that come because I didn't make the tax law get any more complicated, although I do appreciate that it is complicated sometimes. So,
But it would be well worth the service, well worth the advice, obviously.
I believe so. Yes.
Yeah, and I think that's a good point, Lynn, that I think when people are going through divorce, they often panic over money and they don't want to spend the money. I think of it in terms of, is this an expense or an investment? And this is truly an investment in your future, because it's very hard to go back and fix things. And some things, many things in divorce, we can't go back and fix.
That's right.
So get the advice when you're in process.
All right, so the last thing on my list, maybe the most complicated of all, is if one person in the divorce, or both, is self-employed, we now have this entirely new thing called the Qualified Business Income Deduction, the QBI or the QBID, some people call it. That applies to some people and doesn't apply to others. And of course, part of the child and spousal support calculation is the income of both parties. And for someone who's self-employed, it's their income after their allowed business deductions. Sometimes there's add backs for personal things that are written off as business items. And so it's always been a little complicated in divorce when we're calculating business income, because they'll say, oh, but my tax accountant says I only pay taxes on $25,000. But there's certain things that are allowed to be deducted for the IRS purposes that in child support, spouse support calculations, we add back. Now we have this qualified business income deduction that really doesn't get calculated accurately until the end of the tax year. So how are we supposed to figure out child support and spousal support before the end of the tax year for the year that we're in now? Dave.
You call the tax advisor and you give him or her as much information as you can so that it's an accurate of projection as possible, because the QBID, the Section 199 Cap A deduction, which is also called the flow-through deduction when they were going through all the talking about it on the news and everything, it has so many different layers as far as thresholds and what's going to be the actual deduction, that it's difficult to just say, hey, I'm going to make $150,000 on my Schedule C. Am I going to get 20% of that? No idea. It's impossible to know just from that, because one, there's the type of business it is. If it's one of the what they call like a qualified service business, like a CPA, an attorney, financial advisors, those sorts of things, those don't automatically qualify for the deduction. So then you have to look at, well, what's your income before this deduction? Because if it's under certain thresholds, then it doesn't matter what kind of business it is. You get to take that 20%.
And what's that threshold?
For married filing joint, the threshold starts to phase out at $315,000 of taxable income. So that's your adjusted gross income after your itemized or your standard deduction. So that's, you kind of get to this number here, and then below that is where you put that threshold limitation calculation into play.
And for single people, because we're talking about people who are going to be divorced.
Right. So for single, it's the phase out starts at 157.5, and I think it fully phases out around 200 or so.
So there's a whole new consideration now when you're thinking about whether or not you want to get divorced if you're self-employed, that drops that limit almost in half.
Yes.
For qualifying for the QBID. Or maybe if you're thinking about getting married and you're self-employed, you want to get married sooner rather than later because it increases that threshold. So
That's
it's
right.
not all bad news.
And your marital status is for taxes, your marital status on the last day
of the year. Everything
so
is
doesn't matter
just
the rest of the year.
Right.
But if you got married on December the 31st, you're married for tax purposes.
That's correct.
Or if you got divorced on
On
December
31st,
31st,
you
you're
are
divorced
divorced on
for tax
tax purposes.
purposes.
Yep.
So it works both ways. So one of the things that we as lawyers and financial advisors in the divorce arena have been talking about is how do we come up with accurate support numbers when we have one or more parties involved in that are self-employed, that are 1099 employees or have their own businesses, is, you know, how do we come up with an accurate number if we were trying to predict what's going to happen over the next year or 6 months. And if we don't turn out to have accurately predicted it, then how do we fix it? Dave?
It is very difficult to predict what it's going to be. It's going to take a lot of estimates. It's going to take discussions with the spouse that is the business owner. You know, what's your year going to look like, or what deductions you have. It's
Okay, well, anytime you're getting divorced, the
Right.
business owner's going to say it's going to suck.
right. Oh, absolutely.
And the about-to-be ex-spouse is going to say, yeah, but he's been making more, or she's been making more money every year for the last 5 years.
Even when they're
or
not
there's
getting
no
divorced, a lot of times the
reason.
business owner doesn't think that he's going to have that much income or she's going to have that much income,
Yeah.
and then you get to the tax prep time, it's like, you said you weren't, and this is okay. Hope you got your checkbook because we're going to have a tax payment to make now. Unfortunately, there's just no easy answer to how to project it, or at least until we get to a point where if it's a steady business, it's going to be relatively the same as the prior year, you may be able to just say, okay, is it looking like last year? Yeah, okay, then let's assume this is going to be the QBID and true it up later if you need to.
So Dave, for our viewers today, you are taking new clients, yes?
I am taking new clients.
Great. And Dave can be reached at dave@gibbs-cpa.com. And I want to remind people our next Facebook Live show is going to be February 26th at 1 o'clock. Join us here. And Shawn Skillin can be reached at ShawnSkillinLaw.com. Mark Hill at PACdivorce.com, P-A-C divorce.com, and you can reach me, Lynn Waldman, at divorcecounselingcenter.com. And this Saturday we have another divorce options workshop where you can get more questions answered about divorce beginning at 9 a.m. in Carmel Valley. We'd love to see you there. And if you would like to register, please call 858-472-4022. And we will see you guys next month on February 26th.